The US government recently attempted to raise $119 billion, 0 cents, through Treasury bonds. But this time the usual buyers didn't show up. Demand was weak, yields surged, and Wall Street analysts are calling it the most alarming bond auction in recent memory. If global investors stop financing America's debt, what happens next? This isn't just a matter of high debt, it's a crack in the global faith in the US dollar. In this video, we'll unpack what's happening in the bond market, why it matters for your financial future, and how it could be the spark for the next economic crisis. The June 13, 2025 bond auction started like many before it. The US Treasury planned to issue short and medium-term bonds to fund everything from social security to defense spending, but unlike previous auctions, demand was notably soft. The bid-to-cover ratio, a key gauge of investor interest, was just 2.1, the weakest in over a decade. Meanwhile, the yield on 10-year notes spiked to 5.1%, levels unseen since the 2008 crash. This sudden change signals something bigger, a shift in investor confidence. Treasuries have long been considered one of the safest investments on earth. Now, even that is being questioned. Why are investors pulling back? Several red flags are converging. Exploding federal debt, now over $36 trillion, 0 cents. Persistently high inflation. An uncertain Federal Reserve caught between rate hikes and recession fears. Declining foreign appetite for US bonds. Major holders like China, Japan, and oil-rich nations have been scaling back their treasury portfolios, citing geopolitical risks and a desire to diversify. As fewer buyers step up, the Treasury must raise yields to make bonds attractive, which in turn increases federal interest payments, creating a self-perpetuating debt spiral. This isn't just another bad auction, it's a wake-up call. What's fueling the global doubts? The fundamental issue is no longer just numbers, it's trust. Investors worry the US government may not have the political will to rein in spending or tackle the deficit. Shutdown threats, debt ceiling fights, and budget brinkmanship have become the norm. That instability breeds hesitation. At the same time, foreign governments are moving away from the dollar. China has offloaded hundreds of billions in US bonds and increased its holdings of gold, euros, and other assets. Nations like Japan, Saudi Arabia, and Brazil are following suit, not just for economic reasons, but for strategic independence in a world where US financial assets carry political risks. Meanwhile, private investors are exploring safer or higher yielding options, from gold and emerging market debt to cryptocurrencies and corporate bonds. The result? Reduced demand for treasuries, higher borrowing costs, and a fragile foundation for the US financial system. The global fallout. The US bond market underpins global finance. When it stumbles, the entire world feels it. Rising US yields push the dollar higher, making debt repayment harder for emerging markets that borrow in dollars. Their currencies weaken, inflation spikes, and central banks are forced to raise rates, often triggering economic slowdowns or crises. Just look at Turkey, Argentina, or Pakistan. Europe isn't safe either. Elevated US yields make American assets more attractive, putting pressure on the Eurozone to respond. If the EU raises rates to compete, it could strangle growth in struggling economies like Italy and Germany. And there's the banking sector. Global banks hold trillions in treasuries. As bond prices fall, so does their capital, hurting their lending power and tightening credit markets. How this affects everyday Americans. Think bond auctions don't affect you? Think again. Rising treasury yields spill into every corner of the economy. Mortgage rates are now hovering near 7.8%, pricing out millions of potential home buyers and slowing real estate activity. Credit card interest rates have soared above 21%, squeezing households already battling inflation. Small businesses face higher borrowing costs, curbing expansion and hiring. Federal interest payments are ballooning, potentially exceeding $1,500 billion, 0 cents annually within a few years. That's more than the entire defense budget. All of this strains public programs like Social Security and Medicare, and could mean higher taxes or painful spending cuts. Even retirement isn't safe. Bond-heavy portfolios like 401ks and pensions are taking hits as bond prices drop. For those nearing retirement, the timing is brutal. At its core, this isn't just about bonds, it's about confidence. If the world stops trusting the US to manage its finances, America's privileged status as the issuer of the world's reserve currency is at risk. That would upend global markets and bring financial volatility to Main Street. This failed bond auction was more than a market blip, it was a flashing red warning. Understanding the risks now is key to navigating what could be a turbulent future. Stay informed, stay prepared.